Is the rise of Bitcoin on the 4-hour chart worth trading for us? If you are interested, please keep watching. Bybit is one of the best exchanges I've ever used. It provides great market depth, a smooth user experience, and an impeccable interface. It now has an unprecedented event. After completing KYC and making a deposit of $500, you get a $1,000 Ethereum futures position. You can choose either to go long or make a short call. Let's take a look. If you're interested in this event, click the link down below, and you will be brought to this page. If you complete your mission, you can choose to open either an Ethereum long position or a short position. This position is given for free. If you close a position and you make a profit, you can make a withdrawal. There won't be a problem at all. If you lose money, if you get a margin closeout, it's alright. This position was given for free anyway. This event is for new users only. You have to make a deposit of $500 and complete the KYC. 10 spots have already been taken. There are only 90 slots left. After all the slots are taken, we might not get another similar event. Act fast. Okay, let's look at Bitcoin's price. So with Bitcoins, starting this discussion with the 4-hour time frame is a little too narrow-sighted. We start with the weekly candlestick chart. Starting with the weekly chart, I took a look at it. I drew the price channel over here. I think the price channel is valid. You will notice the contact points at the top and bottom, both sides. The contact points on both sides are worth studying. You will notice that there are 2 perfect contact points at the top. There are 2 more at the bottom. There is one over here. Now we go over here. There is one here. There is another over here. Over here. And here. So, there are 4 points. They are on the top and the bottom lines. So, the price channel is valid. So, there is another narrative. Maybe the bear market isn't ending anytime soon. The bear market follows the price channel. So, we see a decline over here. The increase after the 15,000 mark is a rebound. It will drop afterward. I think this narrative, or this idea, is very out of coordination with the bear market and the period of Bitcoin, which means these are not in sync. The chance of it going in this trend is low. Very low. Why is that? First, we take a look at the part with the price increase. If this really is a price rebound, or a false breakout, in this following price decline, everyone who has bought in Bitcoins, or gone long, will be forced to sell off their chips. In other words, there might be a margin closeout. Let's take a closer look. The range down here covers a span of 300 days. This is a box pattern that has lasted 300 days. If we want to come back after a breakdown, we need another box down here that spans at least 200 to 300 days. And the trading volume must be at least the same as this part. If we match it with the US overall economy, the interest rate increase is coming to an end. It will end either this month or the next. It will end soon. If we review Bitcoin's previous price fluctuations, we can notice that when the interest rate increase comes to an end, before it actually ends, the price of Bitcoin will slowly recover. If the price continues to fall to this spot, it will be completely decoupled from the US economy. That is abnormal. If we have a fluctuation here, it takes time for the price to fall. The fluctuation takes time. It takes time for the price to go up. So, it's impossible for us to see the massive price hike, as in the previous bull market, during the halving event of the year 2024. It won't happen. The price is still undergoing adjustments. So, that is unlikely to happen. Okay, next. Now we go to the daily chart. There are more things to discuss with the chart. First off, should we go after this first wave of the price increase? Personally, at least from the current situation, is it likely for it to be a real breakout and continue to increase? The possibility is there, but the possibility is much lower than in previous waves. Take this wave for an example. This would be a good entry point. And the position over here too. Both would kickstart a trending market. For this trending market, the entry point should be at the blue arrow. If you look closely, you can see the spots. These blue arrows point at have something in common. Back then, these 2 spots. First of all, the speed of the price increase was insane. The candlesticks were continuous. You can see that. We see a price surge here. The price increase was fast and continuous. It's hard to trade. It's too challenging. But if you had managed to get started here, there is no doubt you would have made a huge fortune. However, why was there a buying frenzy? It was to minimize the number of people that bought at this price. This is the institutional investors' main force. It's when they open their positions. Why would they let most people open their positions and make a fortune with this price? But as you can see, this breakout, this spot here, forms a very apparent contrast. It's different from what we discussed earlier on. The situation is different. So, I'm using a red arrow to show the difference. When there was a breakout, the trading volume couldn't catch up to the previous volume. Secondly, the range of the breakout was short. After the breakout, the trend wasn't going strong. There was barely any increase. The price was oscillating for a while here. And then the price went up again. The trading volume wasn't enough either. This is very different from our previous situation. But right here, if it becomes a starting point for a bullish trend, there's only one possibility. It will go up slowly. It goes slowly. We won't see a bearish sign with a surge in trading volume. If you see that in the price drops, it's very risky. And we can take a look at this. The MACD of the daily chart. A day is a relatively larger time frame. If it's only an hour or 4, if there is a divergence, then the reference value won't be as high as the daily charts. In the beginning, at this part, we can see the momentum exhaustion. The price is going up, but the MACD is going down. The signal is here. We get a pullback here. Now, at the same spot, over here, the price is going up, but the MACD, it's a pullback. Yes, it hasn't been confirmed. Has it been confirmed yet? No. We haven't seen a real death cross. It hasn't shown up yet. The red MACD bars haven't shown up yet. We need both signals. They appear at the same time, normally. There is a death cross, and the MACD indicator shows a red bar. Only then can we have a divergence. Judging by the situation, it hasn't been confirmed, but it could become a divergence. It's very likely to. If the pullback goes deeper, that will tell us this wave of price increase is ending. The two parts of the price increase will go through momentum exhaustion. MACD will get a divergence. That signals danger. MACD will always be a lagging indicator. The situation the MACD indicator is showing is from a previous time frame, not the current. It shows the price situation from an older time frame. If you see over here, the weekly chart does show a divergence. But when we notice that the weekly chart shows divergence, it won't be when the price is high. The price will have gone down a little. As you can see, the price was hitting a record high, but the MACD was showing divergence. That is valid. It's on the weekly chart. What can you spot to see the max divergence? We can only spot it when the first red bar shows up. Only then will we know. You will only find out after the price plummets to 42,000 US dollars. Only then will you know. But you might exit when it's 51,000 US dollars. A little over 51,000 US dollars. That alone is also impressive. But MACD is certainly a lagging indicator. Until the price sends any signals with its trend, there is no way you can tell from the MACD indicator. Now, look at the 4-hour time frame. The 4H chart. If we notice that the price drops below this point, which is 28,800 or 28,900 US dollars, we can announce the upward trend is a false breakout. This upward trend is more than likely a false breakout. Now, look at the trading volume. Take a closer look at the trading volume. The trading volume in the box here. First, the trading volume of this price breakout. This is it. This is what it looks like. It's not much different from the one in the price consolidation area, right? This breakout is very weak. Moreover, let's focus on this range above and ignore the trading volume of this breakout. What do you see? The sellers are dominating the market. In this red rectangular box, the sellers are dominating. I think that is a signal of danger. And last, let's take a look. At this point, you can make out the head and shoulder pattern, right? I think we should be careful. If it falls under the neckline, the chart might show the risk of further plummeting. But it's the weekend. So the trading volume isn't showing up yet. We can wait until Monday and see how changes are made. And lastly, look at Ethereum. For Ethereum, these 2 days is the most critical time. There is an unlock of staked ETH. After the Shanghai upgrade, the sell-off is the most serious. 3 to 4 days afterward. That means today and tomorrow. For today and tomorrow, we have to pay attention to Ethereum sell-off. There's a minor pullback here. But is the pullback very substantial? How will it affect the market afterward? We will get the answer very soon. Alright, thank you. You're welcome to like and share my videos. And subscribe to my channel. Turn on the little bell button to show me your greatest support. Thank you so much. Bye-bye.